Charlie Munger once said, "The first rule of compounding is to never interrupt it unnecessarily." Those words carry more weight now than ever before, especially if you're starting from scratch in 2026. Charlie understood something profound that most people miss. Wealth isn't built through brilliance or lucky breaks. It's built through patience, discipline, and refusing to sabotage yourself with emotional decisions. Keep that wisdom in mind as we walk through this complete strategy together. Now, imagine waking up on January 1st, 2026. You have $0 in assets. No stock portfolio, no bond holdings, maybe just a little debt hanging over your head and a job that pays the bills but not much beyond that. You open your phone and the financial headlines are absolutely screaming at you. Stories about interest rates, AI threatening to take jobs, housing prices that look like phone numbers. It's overwhelming, and honestly, most people freeze right at this moment. They look at this landscape and assume the game is completely rigged against them, so they don't even bother picking up the controller. They resign themselves to financial mediocrity before they even start. But here's what I want you to understand. If I had to start from absolute zero right now, knowing everything I know about compounding, market cycles, and human psychology, I wouldn't panic. Not even a little bit. In fact, I would argue that 2026 presents a cleaner, more straightforward entry point than we've seen in a decade, provided you can tune out the constant noise and fear-mongering. The strategy I'm about to lay out for you isn't about getting rich by next Tuesday or finding some magical investment that doubles overnight. This is the mathematical path to your first $100,000, and eventually your first million, specifically designed for the economic reality we're stepping into right now. It starts with confronting a number that most people are absolutely terrified to look at honestly. Before we dive into the spreadsheet and start crunching numbers, I need to make a deal with you. I'm going to break this entire roadmap down into 4 specific phases that build on each other: the foundation, the engine, the portfolio, and the tax shield. This is a complete system, not a collection of random tips. And I want to be crystal clear, I'm not selling you a course at the end of this video. There's no pitch coming. The only cost of admission here is your attention and your willingness to be honest with yourself. If you want to treat this channel like a peer review session for your personal finances, where we dig into the real numbers and the real strategies that actually work, go ahead and hit that subscribe button. My goal is to give you the highest possible return on investment for your time spent on YouTube. No fluff, no hype, just the strategies that compound over time. Now, if I'm starting at absolute zero, the very first thing I have to address isn't which hot stock to buy or what cryptocurrency is going to moon. It's the invisible anchor that's dragging me backward, often without me even fully realizing it. I call this the negative compounding trap, and it's usually disguised as something that seems manageable, just a monthly payment on a credit card statement. There's this pervasive myth floating around that you can somehow out-invest your bad financial habits. I see people all the time in the comments asking whether they should put money into some cryptocurrency or a trendy tech ETF while they're simultaneously sitting on thousands of dollars in credit card debt, charging them 20% or even 24% interest. They think, well, if the market historically does 10% and my debt is costing me 20%, I can just catch up later once my investments grow. This kind of thinking is the financial equivalent of trying to fill a bucket that has no bottom. The water just pours right through. If I'm starting fresh in 2026, I have to accept a brutal truth. My net worth isn't actually zero. It's negative. And until I fix that fundamental problem, the stock market needs to remain completely off limits to me. I know that sounds harsh, and it's not what you want to hear, but mathematically, paying off a credit card charging 20% interest is giving you a guaranteed 20% return on your money. You literally cannot find that kind of return in the stock market without taking risks that could completely wipe you out. Let's run the actual numbers on this because feelings lie all the time, but mathematics doesn't. Say you're carrying $5,000 in consumer debt at 24% annual interest, which is pretty common for credit cards these days. If you make only the minimum monthly payments that the credit card company suggests, you're going to end up paying back nearly double that original amount over the next decade. Meanwhile, if you took that same monthly payment amount and invested it in the stock market instead, sure, you might make some gains. But the interest drag on that debt is literally eating your financial future alive, faster than your investments can possibly grow. In 2026, with interest rates likely stabilizing but definitely not returning to the 0% environment we had after the financial crisis, the real cost of borrowing money is substantial and unavoidable. Every single dollar you pay in interest is a dollar that isn't compounding and working for you. It's gone forever, enriching the bank instead of building your wealth. So my strategy at zero is aggressive and uncompromising. I'm not an investor yet. I'm a debt destroyer first. The math absolutely dictates that I must clear the decks completely before I even think about trying to build the house. Charlie Munger would have called this removing the stupidity from your financial life before trying to be clever. Here's the psychological twist that catches so many people in this trap. We keep debt around because it feels manageable. It becomes just another monthly line item in the budget, like your Netflix subscription or your water bill. We normalize it. We tell ourselves, well, everybody has some credit card debt. It's just part of modern life. But psychologically, debt creates a scarcity mindset that poisons every other financial decision you make. When you owe money, you become afraid to take career risks that might advance your income. You're afraid to ask for the raise you deserve because you can't afford to rock the boat or potentially lose the job. You're afraid to move cities for a better opportunity because what if something goes wrong and you can't make the payments? The true cost of that debt isn't just the 24% interest you're paying. It's the opportunity cost of the life you're too scared to live because you're psychologically shackled to a bank. Clearing this debt isn't just a financial move. It's a psychological unlock that allows you to play offense in life rather than always playing defense. This means I'm selling things I don't actually need. I'm downgrading or canceling subscriptions that don't add real value to my life. I'm treating this debt payoff like a genuine hair-on-fire emergency, because mathematically, that's exactly what it is. Once that highest interest debt is completely eliminated, I don't celebrate by buying myself an expensive watch or taking a vacation. Instead, I take that entire monthly payment amount I was throwing at the debt, and I get ready to pivot to the next phase of the strategy. But wait, before we start putting that freed-up money into the stock market, there's a massive trap that probably 90% of new investors fall into, and it destroys their wealth-building journey before it even really begins. You might be thinking, okay, I've paid off my debts. Now it's time to buy the S&P 500 and start building wealth. If you do exactly that without this next critical step, you're statistically likely to fail within 18 months and possibly even blow up your entire financial life. Why? Because life happens. It always does. The car breaks down and needs a $1,500 repair. You need an emergency root canal that insurance won't fully cover. Your laptop dies and you need it for work. If all your available money is tied up in the stock market and the market happens to be down 15% when your car breaks down, you're forced to sell your investments at a loss just to fix the car so you can get to work. You've just locked in a permanent loss and completely destroyed your compounding trajectory. This is how people fail at investing, even when they're doing everything else right. We need a buffer, a financial shock absorber. Now, the common belief you'll hear from influencers and talking heads is that cash is trash. They'll tell you that inflation is eroding the purchasing power of your cash sitting in a bank account, so you need to be fully invested at all times to fight that inflation. While inflation is definitely a legitimate concern that we need to address, cash serves a completely different function in the early stages of wealth building. It isn't an investment generating returns, it's insurance protecting you from disaster. If I'm starting my journey in 2026, I'm building what I call a cash fortress before I buy a single share of stock. This is my sleep well at night fund. It needs to be completely liquid, immediately accessible, and boring as hell. No Bitcoin, no stocks, nothing volatile. Just cash sitting in a high-yield savings account. People absolutely hate this part of the strategy because it feels like you aren't making any progress. You watch that number in the savings account and it barely moves. It might earn 4% interest if you're lucky, which seems pathetic compared to the stock market's historical returns. It feels stagnant and frustrating. But that perceived stagnation is actually rock-solid stability, and stability is what allows you to take smart risks later. Let's look at the actual math of having a cash buffer versus not having one, because this is where theory meets brutal reality. Imagine two investors starting their journey at the same time. Investor A puts absolutely everything into the stock market, going all in because they want maximum returns. Investor B keeps $10,000 in a high-yield savings account earning about 4% interest and invests the rest. Then the market corrects by 20%, which, by the way, happens on average every few years. This isn't some doomsday scenario, it's normal market behavior. Both investors lose their jobs during this correction. Maybe there's a recession, maybe their company does layoffs, whatever. Now what happens? Investor A has to sell their stocks at the absolute bottom of the market crash just to buy groceries and pay rent, permanently locking in that 20% loss. That money is gone forever. Investor B, meanwhile, uses their cash buffer to cover expenses, leaves their investment portfolio completely untouched, and patiently waits for the inevitable recovery. By the time the market bounces back, and it always has historically, Investor A is financially devastated and potentially out of the market entirely, while Investor B is whole and their investments have recovered. The math overwhelmingly favors the person who never has to sell at the wrong time. But there's an even deeper psychological layer here that most people miss. When you have 3 to 6 months of expenses sitting safely in a bank account, you literally walk through the world differently. You negotiate differently at work. You're not desperate or afraid. This psychological shift prevents you from making emotional financial decisions driven by fear and panic. Most catastrophically bad investing decisions come from exactly two emotions: panic selling when everything is red and scary, or FOMO buying when everything is green and exciting. A proper cash buffer creates a crucial psychological gap between stimulus and response. It allows you to look at a market crash and genuinely see a sale, an opportunity to buy assets cheap, rather than viewing it as a catastrophe that requires you to panic and sell. Without this buffer firmly in place, you're essentially trading with your emotions, and I promise you, the market will absolutely bankrupt you for that mistake. The protocol here is completely non-negotiable if you want this strategy to work. I'm calculating my absolute bare-bone survival number: rent or mortgage, basic food, essential utilities, minimum transportation costs to get to work. Nothing else. I multiply that monthly number by 3 to get my minimum target. That's the amount I need in my cash fortress. I'm opening a high-yield savings account or putting it in a money market fund. Both are FDIC insured and completely liquid. In 2026, these tools are incredibly easy to access through apps and online banks. I'm automating a transfer from my checking account to the savings account every single payday, treating it like a bill I have to pay. This happens before I see the money, before I'm tempted to spend it. I continue this automated transfer until this bucket is completely full. Once it's full and sitting there earning its modest interest, I pretend it doesn't exist in my day-to-day life. It's not for vacations. It's not for a new phone or a new TV. It's exclusively for survival-level emergencies. Only when this bucket is overflowing and secure do I even allow myself to look at the stock market. And this is where things get genuinely interesting, because conventional wisdom says you should diversify your investments across many different assets. But I'm going to tell you something that might surprise you: you need to focus and concentrate, not diversify at this stage. You've got your debt paid off. You've got your cash buffer fully funded and sitting safely. Now you have an extra $500 or $1,000 a month that you can actually invest. Conventional wisdom, the advice you'll hear from most financial advisors, says to buy a little bit of everything. Buy some domestic stocks, some international stocks, maybe some cryptocurrency, maybe some gold, some bonds, spread it around. But this approach is actually a strategic mistake when your portfolio is still small. Over-diversification at the beginning of your wealth-building journey doesn't protect you from risk the way it does later. Instead, it virtually guarantees mediocrity. You need concentration to build wealth, and you need diversification to preserve it once you have it. These are two different phases requiring different strategies, and confusing them will cost you dearly. The allure of individual stock picking is incredibly strong, especially in 2026. We all want to find the next Nvidia or Amazon or Apple before it explodes in value. If I'm starting fresh this year, the temptation to use AI-powered tools and algorithms to pick individual winning stocks will be absolutely everywhere. Apps and platforms will promise you AI-driven alpha, superior returns generated by artificial intelligence. But here's the harsh reality that nobody wants to hear: finding a winning needle in the haystack of thousands of publicly traded companies is incredibly difficult, even for professionals with Bloomberg terminals, teams of analysts, and decades of experience. For a retail investor like you or me, working a regular day job and trying to research stocks in our spare time, consistently picking winners is nearly impossible. The myth that needs to die is that you need to be smart enough or savvy enough to pick the winning stocks. The reality is that you just need to be smart enough not to pick the losers, and the way you do that is by buying everything. Let's look at the SPIVA scorecards. These are comprehensive studies that track how active professional fund managers perform against simple index funds like the S&P 500. Over a 15-year period, more than 90% of these active managers fail to beat the basic index. Think about that. These are people paid millions of dollars annually, with entire research departments, insider access to company management, sophisticated computer models. And 9 out of 10 of them can't beat the market average over the long term. If they can't consistently do it with all those advantages, what are the odds that I'm going to do it successfully in my spare time while working a full-time job? The odds are statistically zero. But here's the beautiful part: if I simply buy the entire haystack, the total stock market index, I'm guaranteed to capture the market return. Historically, over long periods, that's been around 10% annually before inflation. Sure, any individual year might be up 30% or down 20%, but over decades, it averages out to remarkable wealth building. If I try to pick individual stocks instead, the distribution of possible outcomes widens massively. I might get incredibly lucky and make 50% or 100% returns. Or I might pick a company that goes bankrupt and lose everything I put into it. In the early stages of wealth building, when you don't have much capital to work with, reliability and consistency beat lottery tickets every single time. The math says, be average, because being average in the stock market over 30 years makes you wealthy. It's boring, but it works. The problem with index investing isn't that it doesn't work. The historical data proves it absolutely works. The problem is that it's incredibly boring. It provides zero dopamine hits to your brain. You buy a fund like VTI or VOO, and then literally nothing exciting happens. There are no dramatic earnings calls to listen to, no rocket ship emojis, no daily excitement, no stories to tell at parties. Psychologically, our brains crave action and stimulation. We want to feel like we're actively doing something clever to earn our wealth. This psychological need for action is exactly why people get sucked into day trading or options trading. They're paying massive fees and taking enormous risks just to feel involved and engaged. They're basically paying for entertainment disguised as investing. If I'm implementing this strategy starting in 2026, I have to hack my own brain and its destructive tendencies. I need to genuinely accept that good investing should feel like watching paint dry. If my investing is exciting and getting my heart racing, I'm probably gambling, not investing. Charlie Munger understood this perfectly. He once said investing should be boring, and exciting investing is usually unprofitable investing.